market sentiment was once again very different on both sides of the Atlantic. The European markets remained under the pressure of tense political environment in France and a 3% slump in April manufacturing production across the Eurozone. And even a softer than expected PPI read from the US couldn't prevent the Euro-USD's decline yesterday. But on the other side of the Atlantic Ocean, the producer prices fell on a monthly basis, the first monthly decline since January, and the yearly figure eased to 2% while analysts were prepared for a rebound to 5%. Cherry on top, the jobless claims jumped to the highest levels in 9 months. Both data played in favor of the Fed doves a day after the Federal Reserve hinted that they see little progress regarding inflation instead of none at their previous communication and should have pulled the US dollar lower, in theory, but the sell-off in the euro against the greenback weighed heavier, and the Bank of Japan decided not to reduce its JGB holdings until the July meeting. And that also fueled a yen sell-off and sent the USD JPY toward the 158 this morning. In summary, the US dollar bears couldn't take advantage of softer data yesterday due to contradictory dynamics elsewhere. The probability of a September rate cut rose to 65%. The probability of a November cut stands at around 80%, while a December cut is now given around 95% chance. Many investors are still skeptical regarding the feasibility of a 2024 cut, and inflation figures haven't been appetizing so far this year, but the latest figures are encouraging. Yesterday's PPI, for example, also hint that declines in some categories in the PPI like airfare and prices for portfolio management services, which also feed into the Fed's favorite gauge of inflation, the PCE index, hint that we could see the PCE index show the slowest advance since November when released later this month.